Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is John Kerschner, Head of U.S. Securitized Products at Janus Henderson Investors. John, it's nice to meet you virtually. How are you doing today?
Great. Thanks for having me, Todd. Pleasure to be here.
Of course. Well, we just wrapped up our CLO conference a couple weeks ago, and ETFs and CLOs was probably one of the bigger topics at the event, and certainly has been one of the more exciting innovations of the last few years. Where is this growth coming from, and kind of what do the next few years look like after we've gotten to where we've gotten to?
Yeah, I get this question a lot, not surprisingly. Bottom line is, until we launched JAAA, which actually was in October of 2020, going on 4.5 years now, I guess over 4.5 years, time flies. But there was very difficult for retail investors or even institutional investors that didn't have a huge team of credit analysts to get exposure not only to CLOs, but to really any high quality floating rate fixed income in the US, particularly high quality floating rate fixed income that had a decent yield. And because in the US, fixed income market is just that, it's fixed. Globally, there's a lot more floating rate securities that are issued, but in the US, we're mostly a fixed rate market, vast majority. Our indices, particularly the Bloomberg aggregate index, is all fixed rate securities. So people tend to think of fixed income as fixed. And as we saw, particularly in 2022, I think that year put a lot of investors on a very bad ride. What I mean by that is, I think a lot of investors are used to equities having that kind of volatility. Depending on your equity portfolio is probably down kind of around 20%, but people aren't used to fixed income being down 10, 12, 15%. And people have gotten used to kind of equities and fixed income being negatively correlated. That's been the case for much of the last, call it 20, 25 years. But in 2022, they were obviously positively correlated, right? So equities went down, fixed income negative, and one of the few asset classes that performed actually quite well were CLOs, particularly AAA CLOs. JAAA was positive that year. We got a lot of thank yous from our investors saying, really appreciate JAAA. It was the one thing in my portfolio that performed well. And so I think now you go into this new environment of obviously tariffs, higher inflation. Obviously that leads to higher interest rates. And for many years, probably most of the people listening or watching this podcast have been used to interest rates going down over their investment career. Now maybe that's not the case. So people are thinking, how can I have some diversification in my portfolio? How can I insulate my portfolio? And this is a great asset class and a great product for that. So I think that's where a lot of the growth has come from. And I think it will continue over the foreseeable future.
A little bit more about Janus. How many ETFs do you guys have? What's the AUM today? What does the investor base look like?
Well, I should know this question in aggregate. I do not. We're launching a lot of them. So I would say we probably have now, as we sit here, somewhere around 15 ETFs. It's a little bit of a guess, but the ones that I manage are all securitized because that's my livelihood, the securitized markets. But we have JMBS, which is an active mortgage ETF. That was our first one in securitization here. That launched in 2018. We have JAAA, which we talked about. AAA CLOs launched in October 2020. I should have mentioned JMBS is about 5.3 billion. JAAA right around 20 billion. JBBB was launched in January of 2022. It's about 1.3 billion. That focuses on BBB CLOs. We have JSI, which is Janus Henderson Securitized Income. That focuses more on ABS, CMBS, and non-agency mortgages. That's about 750 million, about a year and a half old. And now we're looking at launching a lot of these products, but in UCITS wrappers for offshore investors. So we have JCL0 over in London. That's actually a Euro CLO AAA ETF. We have just launched JAALN, which is a UCITS wrapper for offshore investments, for offshore investors for JAAA. We just launched JMBSLN, also offshore for JMBS. Obviously, you can connect the dots where we're also thinking about. But we have other products in the hopper as well. So, and not just on the fixed side, we're also launching some equity type products. So continue to expand what we're doing in ETFs here at Janus Henderson. We believe in active management, but we also believe that ETFs are very important. We have this great track record of not only launching and managing ETFs, but growing ETFs as well. And I think that's very important for our investors.
And what does the investor base look like? Maybe focus more on the CLO one as we're kind of maybe hone in on that particular product.
Yeah, I thought you would ask this question, so we did a little research. It's somewhat difficult to get a precise number on this, and not everybody's definition of retail versus institutional. That's usually how it's broken down is the same, but it's about 60% institutional for JAAA. And so that's not a big surprise because what we hear a lot from investors, even big, rather big institutional investors, is they don't want to spend the time and effort, hiring the people, doing all the due diligence. There's 130 plus or minus CLO managers out there just in the US, another 60 or 70 over in Europe. We meet with those CLO managers. We get to know their investment process, how they look at risk, how they manage portfolios. It takes an awful amount of work, hundreds of hours. Quite frankly, we have to surveil the portfolio, obviously trade in the markets. For being able to buy a product, like I said, 20 billion, incredible liquidity, trades with 1 penny bid-ask spreads. That did not change over the last 6 to 8 weeks during this bout of volatility. One day we traded up north of 1.2 billion in size in JAAA, so incredible liquidity. And a relatively low fee for a vast number of investors out there, both obviously retail, but even institutional. It makes a lot of sense to outsource that to us at Janus Henderson, and that's kind of why we have such a large investor base, and a lot of those investor base is actually institutional.
When you went, just one follow up on that, when you went into creating it, was your hope to be 60-40, 50-50? Like, was there a thinking when you went into it, like, hey, if we can get to this, it would be an ideal product?
Not really.
Okay.
Look, I think if you look at Janus Henderson overall, I think it's a little bit flipped. I think we're probably more like 60-40, with 60 being retail 40% being institutional. I may be slightly off on that. It varies by region and varies by product. But look, we believe that we are a great institution money manager for both institutional and retail investors, and we pride ourselves on that. And look, I think a lot of people have thought about ETFs as being more of a retail product potentially, but what we like to think about is bringing kind of an institutionalized market to the retail market. So CLOs traditionally, institutional product, there was no liquid product easily tradable for retail. And one thing a lot of people don't know, if you wanted to buy a CLO as a retail investor before JAAA, the minimum, what they call the minimum piece, the minimum amount you could buy at a time was 250,000. So if you wanted,
that's not really retail.
No, that is definitely not retail. At least not the retail I hang out
Yeah,
with,
me either.
right? So if you wanted a diversified portfolio, literally you need millions, if not tens of millions, and that really kind of speaks to the institutional market. Obviously, with an ETF, you can buy in very small dollar amounts, and so we're bringing this what formerly was an institutional market to the retail. So we thought it would be more retail, but we are, let's just say, pleasantly surprised how many institutional investors are using it as their primary source of getting exposure to the CLO market.
Late last year, there was a couple of private credit CLO ETFs that launched, and I think there's at least two, maybe even more in the market now. I mean, how do those differ from what you guys do? I think I've heard you say some comments on this in the past. What do those products look like if you're say comparing it to what you guys have built with AAA?
Yes. So for your listeners that don't know, the CLO market is separated into what they call the BSL, a broadly syndicated loan market, and then the private credit used to be called the middle market CLO market. So broadly syndicated, much bigger companies that are coming with loans. The street will sell those to many investors at a time on a new issue, probably 30, 50, 100, different investors. Private credit tends to be kind of one borrower, maybe one lender, maybe three lenders, much more kind of a smaller circle. The private credit companies are usually smaller companies with less EBITDA or earnings, more volatile cash flows. The covenants around those deals tend to be more stringent because it's private credit. Obviously, less liquidity, less transparency. So the private credit, or what they used to call the middle market CLO market, was tiny. So if you think about, on average, the BSL market issues about 100 billion in new CLOs every year. It's a $1.1 trillion market. Until a couple of years ago, the private credit market was issuing more like 5 billion, 10 billion, 5 to 10% of what the BSL market was issuing. And then all of a sudden in basically 23, it went up to like 20 or 25 billion. It just grew basically in that short time period. Also, pretty robust issuance last year. And so it got a lot of energy, a lot of research written about it from the street. I think it came onto a lot of people's radars. We don't really play in that market. JAAA does not buy in the private credit market. The CLO ETFs are relatively small. There is nothing wrong whatsoever with the private credit market or the private credit CLO market, but you do get some more spread in it, but there's a reason for that. The private credit market really hasn't gone through a recession or downturn. Like I said, it comes with less transparency, less liquidity, so untested. And quite frankly, I think when people want a CLO ETF, they're trying to access what I said before: high quality, high liquidity, high transparency, floating rate, relatively high yield. That's what you get out of JAAA. I think less so in these private credit CLO ETFs, but for those people who want a little more yield and are willing to take that more risk and less transparency, could make sense for other people, but it's not what we're offering.
So you referenced the volatile time a few minutes ago. What are your thoughts more broadly on liquidity, volatility, and are you concerned if we hit a sustained downturn, which we've been talking about for quite some time, it seems? Is there a concern around liquidity if we do hit a sustained downturn?
We welcome these bouts of volatility and dislocation, quite frankly, because it shows and proves the use case for many of our products, but definitely JAAA. I think we got a lot of pushback when we first launched this product. CLOs, I think it came from a lot of people that didn't really understand how big CLOs are, how liquid they are, and just bringing this, what people thought of as a complicated institutional asset class to the masses, that wouldn't work as advertised. We have now had two relatively large dislocations. If you talk about what happened in March of 2022 with Russia invading Ukraine, and now this bout of volatility over the last 6 to 8 weeks, obviously not as big as COVID, obviously not as big as the GFC, but still dislocations. And the product has performed exactly as advertised. We tell people, look, if you're able to take this bit more risk in investing in a AAA CLO ETF, and there's definitely more risk, you can get historically, and it comes with a big caveat because past performance is no guarantee of future results, but it's come with about 150 to 175 basis points of excess return versus true cash if you go out and buy a T-bill ETF, for example. And we have seen that in this case, during 2022, we saw a drawdown of about 1 to 1.5%, about 1% this time, but incredible liquidity. Like I said, we were trading some days more than $1 billion of market value. Yes, there were some redeems, but now we're back in create mode. We've gotten close to $1 billion of new AUM in May. And one other stat I like to tell people, because it seems like incredible, but it's actually true. The top 4 months of CLO trading are all heavy dislocation months. So it's March of 2020, obviously COVID, March of 2022, Ukraine and Russia, September of 2022, which wasn't such a big deal in the US, but very big in the UK. That was the UK LDI crisis, and now March of 2025. So this is an asset class that actually trades more, liquidity better during dislocations. We saw that over the last 6 to 8 weeks. So again, another test, proven. I feel that the product gets an A+, exactly as we expected. It performed exactly as we expected it, and we've had no complaints from investors on exactly how it's proven out over the last 6 to 8 weeks.
So you also referenced the institutional investors going through the ETF route instead of exposure primarily or otherwise. And I'm curious, is there a trade-off that an institutional investor is giving by going through the ETF versus gaining exposure more directly? What is that trade-off? Is it, you clearly said hundreds of hours of work and all that goes into it, but when it comes to return and whatnot, are they giving some of that up?
Look, we're very proud of what we do as far as managing the portfolio and doing the due diligence. I think one other thing that's very important for investors to realize is because CLOs are floating rate, and they're usually issued with what's called a 5-2 structure. That means you have a 2-year non-call and then 5-year reinvestment period. So for 2 years, the issuer cannot call it. we have call protection as an investor. For 5 years, if there's a loan in the CLO that matures or gets paid off, the CLO manager can replace that loan with a new loan. So the overall CLO stays more or less the same size for 5 years, and then it starts to amortize down and give cash back to the investors, starting with the AAA tranche. But because the call protection is only for 2 years, if a CLO starts to trade above par, meaning usually that means spreads are tightening, it won't trade that much above par, because immediately the traders on Wall Street will just start saying, well, as soon as the non-call comes off, this will be called. And so, yeah, maybe I'll pay slightly above par, but not much above par. So there's a lot of work that goes into optimizing the portfolio as far as this goes. If everything's trading at a discount, like we saw post-COVID, then you tend to buy more in the secondary because primary obviously comes right at par. These days, not taking out the last couple of weeks, the market was pretty much all trading above par, so we were buying more in the new issue market. So there's a lot that goes on understanding exactly how these deals will be called and how they trade. So look, we obviously charge a fee. It's 20 basis points. I think it's a very reasonable fee for the amount of time, effort, diligence that goes into managing this product. So, every institutional investor obviously has to make their own decision. They give up a little bit as far as the portfolio and how they structure it. But, I think just sitting down with us for 30, 45 minutes, they realize we are best in class as far as what we do here at Janus Henderson. And then it's just a matter of, is the 20 basis points that we are charging worth it? I think for the vast majority of investors, it definitely is.
As ETFs become more dominant in the market, is there a fear that documentation and other parts of a deal might begin to deteriorate a little bit? I mean, you referenced being best in class, but there could be more other ETFs. There clearly are. Is there a risk that the more ETFs that become more dominant in the AAA space, that do you think some standards eventually loosen?
Yeah, I don't think so. I think actually the ETFs tend to keep the documentation more honest, quite frankly, because we become such a big player. And when you think about documentation, you have a CLO manager, right? And they want to do a new deal. And most CLO managers buy at least some of their equity and end up holding some of their equity. You used to have to do that. I think it was until 2017 or 18 because of Dodd-Frank. They kind of got rid of that, but a lot of CLO managers still do that. Shows they have skin in the game. They're eating their own cooking. You pick your saying. And so when you think about it, when you the documentation, you can put language in there that's more equity friendly or bond friendly. And this gets to be very nuanced, and we don't have to spend a lot of time about it. But just for example, once you come out of this reinvestment period, there are rules about, it's not simply that they can't buy a new loan once you come out of the reinvestment period, but it has to be a certain type of loan, and it can't increase the weighted average life of the portfolio. And there's just all these rules around it. The great thing about CLO equity, it has this optionality as far as being able to kind of extend or call the deal. And that's where a lot of the value of the equity comes in, and that's where a lot of the language is. And so if you're a CLO issuer and you're owning a lot of your equity, you're going to try to tweak that language as much as possible in your favor. On the other side, we're obviously debt investors here at Janus Henderson. Other big debt investors are big U.S. banks. The Wells Fargos, the JP Morgans of the world buy a lot of AAA CLOs for their portfolios. Japanese banks, also very large. They tend to push back on some of this language, as do we. because you really, to new issue, you have to have what's called an anchor order in the AAA tranche. Usually that's 100 million plus. If you don't have that order, if you have an order for 5 million, say, well, I want to change this language in the docs, there's zero chance you're going to be able to do that. But if you have a large order, obviously you say, well, we want this deal at this spread, but we want to change this language. And look, I don't want your listeners to feel like we're changing these, these things that are going to vastly impact. It's little tweaks on the margin. It just allows the risk to kind of be more in our favor. So I actually think that's a good thing for us.
What are your philosophies around on leverage in a CLO ETF?
We don't use leverage. We won't use leverage. I don't think it's appropriate because most investors want, transparency. They want to know what they're investing in, what they're signing up for. That being said, we know there are investors out there that are getting leverage on JAAA, so not part of JAAA, but if you're a large investor, you go to your Wall Street bank and say, I'm going to buy JAAA shares. Can you give me 1, 2, 3 turns of leverage on that? Absolutely, that is being done. There are also JAAA total return swaps out there. There are banks that will give you a total return swap. So there are ways of getting leverage. If you are an institutional investor, I won't sit here and say that we will never do a product that is kind of like a 2x JAAA. We have no plans of doing that. But if we had enough investors that say we love JAAA, we'd like to have a leverage product, maybe we would look at it, but it would come with a lot of disclosures. And you might say, well, why not just direct those people that want to leverage JAAA into a JBBB? Obviously more risk, but more return.
Yeah.
And really the finance behind that is sometimes when things, across the capital stack, AAA all the way down, are trading very tight, a lot of investors would rather lever up a AAA security in that instance rather than buying a security down the capital stack. So we don't do it now. We have no plans on doing it. But could there be a situation where a bunch of big investors or a group of big investors came to us and said, we really want a JAAA 2x product? We would consider it, but again, it would not be part of the base JAAA that we have now. We're not going to change that.
Before we jump into some final fun questions, as we're coming to the latter half of the episode, one final question. There's a bunch of CLO ETFs out there today. Is there a concern in 5 years that number triples or quadruples, and what that looks like? And is there too much saturation amongst the CLO ETF market?
It's a very interesting question. I think there are 25 different CLO ETFs out there if you count overseas and US and AAA, mezzanine, triple B, private credit. So just amazing number of CLO ETFs out there. My crystal ball doesn't go out that far. What we have seen, though, in this market and pretty much every other market out there when it comes to ETFs, you tend to get 1 or 2, maybe 3 winners, and then a lot of kind of smaller ETFs that never get any kind of material size, right? And I think that makes sense, right? Because you get one that is doing well and a lot of volume, a lot of liquidity, and that's where people gravitate towards. So if you look at mortgages, you have like MBB and BMBS as passive guys now. There's SMBS, which is Schwab, but you have JMBS for active. Those other ones are passive. And again, I believe active in mortgages makes a lot of sense. And maybe there'll be one other active but like it just doesn't really make sense to have 25 different ones. I would expect some of these will go away eventually, and that we'll end up with a handful of AAA, a few down the capital stack, maybe a couple of private credit, and it will be. I actually think instead of doubling, I think it will actually be many fewer in the next 2 or 3 years, because there's a cost to running these, and if you're not getting economies of scale, it really probably doesn't make sense for some of these smaller ones to stay in existence. So we're happy we were one of the first out there. We're happy we're the biggest out there. We will continue to do that, and I think that we're very well positioned to grow these products and the new products that we're launching as well in CLO.
So some fun questions as we finish up here. Do you have a favorite sports team and/or hobby?
So hobbies. I live in Boulder, Colorado. Janus Henderson is based here in Denver for North America. Our headquarters are in UK and London, but I tend to participate in all the Colorado sports: skiing, hiking, biking, camping, etc. Got to take advantage of it. I feel if you live out here, we're very blessed to live in such a beautiful place. As I look out my window here, I can see the snow-capped Rockies. I may try to get one day more of skiing in this weekend. My daughter just came home from college, and she hasn't been able to ski because she participates in track. So that I'm from Wisconsin originally, so I tend to be Wisconsin sports teams, big Packers fan. But the sport I follow the closest and most passionate about these days is F1. I'm a big Ferrari fan, even though I'm upset they lost Carlos Sainz, who went to Williams. I've been to 4 F1 races. We'll definitely go to more. If people have seen Drive to Survive or watched it on TV, I encourage all those people to go check out a race. There are 3 races now in the U.S.: Miami, Austin, and Las Vegas. It's like most pro sporting events. It's one thing watching on TV. It's quite another level of excitement seeing in real life. So that's what I've been focused on recently.
One surprising thing about yourself.
So I have, I don't know if this is surprising, but hopefully interesting. I have what I consider the best celebrity birthday there is in existence, born on February 12th. Same birthday as both Charles Darwin and Abraham Lincoln. So I consider Darwin a top 5 scientist ever. Lincoln, obviously, a top politician. What a lot of people know that Darwin and Lincoln were both born on February 12th. What a lot of people don't know is they were born on the exact same day, February 12th of 1809. So that was a pretty important day in human history. And so I was a biology major undergrad, and I follow Darwin quite a bit. And another interesting fact is I heard there have been more books written about Lincoln than any human in history besides Jesus Christ. So obviously both very important, and I really love that I was born on the same day as those 2 great men.
Well, speaking of books, what would be one book that you'd recommend reading?
Yeah, so I'm going to give you 2. One, which is it's an animal behavior book. It's called An Immense World by Ed Yong, Y-O-N-G. It won the Pulitzer, New York bestseller. If you have any intellectual curiosity about animals and their behavior, I totally recommend it. It's fascinating how intelligent and animals are, and we're just starting to learn a lot about this. If you think about echolocation in bats and how many things have to go right for that kind of talent to exist for bats, it explains things like that, and it's a very easily digestible book. So love that book. And then This Thing of Darkness is kind of an interesting title by a gentleman called Harry Thompson. It's about the voyage of Darwin and the Beagle. A lot of people know that Darwin went on this voyage in the Beagle when he was a young man, went to the Galapagos, saw the finches, and kind of came up with the theory of evolution. What a lot of people don't know is this voyage took 5 years. It went over to Brazil and went down through the tip of South America. They got kidnapped. They died almost many times. It's a great adventure story. And a great fact is Darwin was in the Galapagos on this voyage for 42 days, but he was only on land for 17 days. So the whole evolution thing was not just the Galapagos. It was not just the finches. It took place over those 5 years. So great adventure book. And the only book written by Harry Thompson. He died soon after he published this book. So those 2 books I would recommend to anybody.
Most exciting part of your job?
I think a lot of people say this, but it's no day is the same. I get to see a huge number of ideas and things within the financial markets. I get to work with smart people, which is great, intellectually curious people. And when people ask me what I do, I think they always think I'm going to say something about bonds or interest rates or macro forecasting. And what I say is, with a little bit of irony, that my job entails making decisions on imperfect information. Like literally, as a portfolio manager, you have to make hundreds of decisions a day, and you could always do more work on these decisions. And it would make a great investor from a mediocre investor is the ability, to be very convicted on decisions and not have to work, hours and hours and hours on every decision. Obviously, we have a team doing the analysis. It's not like you're doing no analysis, but sometimes you just have to go with your gut and your experience level. And because there's something in our business called analysis paralysis, a lot of your listeners might be aware of that. We have had very, very smart young people at this firm, interns, who just at the end of the internship say, I can't do this because I thought there was going to be a spreadsheet, and if I put in all the inputs correctly, the answer was going to pop out. And that is not our business. It's quite the opposite. There's no such magic spreadsheet out there. I don't care who you're talking to. And it comes to a lot of judgment, which comes with obviously experience. And I embrace that uncertainty in my job, because it's like if you make enough good decisions over time, you're making all these decisions a day. If you make enough of those good decisions as far as fundamental value on the bonds you're picking, then really what's happening in the macro world doesn't mean it doesn't matter, but it matters a lot less, right? And so we tend to not make or break on what's going on in the macro world, because that's a hard way to make a living. We tend to do our analysis on the bonds and then be very convicted on our decisions. So that really is the part of the job I love.
You've kind of answered the prediction one, so I'll switch up the last question, since I heard in your answer you went to undergrad for biology. So how'd you go from biology to finance?
So like a lot of young people, I didn't know what I wanted to do. I went to Yale undergrad, and my dad was very interested in me going into the sciences. And so I like biology, still love biology, did a lot of animal behavior classes there. But sometime around sophomore year, I realized I didn't want to go to medicine. I didn't want to be a physician. And I didn't want to be a biologist. Too slow moving, and just the academic life didn't appeal to me. So I thought, well, I really have to figure out what I'm going to do, because my dad was very explicit that he wasn't going to support me after college. And I took a class with some of my roommates, very kind of affectionately called Stocks for Jocks, which there were a lot of athletes in the class because it was a finance class, but it was taught by David Swensen, the late David Swensen, who a lot of people know ran the Yale endowment for many, many years, and really changed how endowments invest. Like before David, it was basically stocks and bonds, very generic, 60-40. And he came in and said, well, these universities really should be around forever. So we don't need the highly liquid instruments. If we can find instruments that are less liquid but yield more, whether it's private equity, whether it's land, whether it's timber, whether it's private credit, whether it's real estate, these universities are ideal and endowments are set up for that. And it was really him that started that method of investing. And so when I took his class, he was probably low 30s. He had gotten his PhD, went to Wall Street, and then Yale recruited him to come run the endowment. So he brought in all his Wall Street connections to guest speak, and he was just a fascinating, young, dynamic professor. And it's kind of a cliche, but I kind of just said, wow, this is something I really think I would like to pursue as a career. And got a job out of college at a small broker dealer called Greenwich Capital. Did that for a few years, then went back to Duke to get my MBA, and kind of the rest is history.
Well, I think that's a good place to leave it. John, really appreciate your time today. Thank you. Continued success with Janus Henderson, and look forward to talking to you again sometime in the future.
Thanks, Todd. I really appreciate it. It was my pleasure to be here.
Thank you.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.